Alright, today we have 3 questions. First, how did AI bots learn to manipulate prices on their own? Second, is there a danger in this for real exchanges? And third, why are regulators at a loss and don't know what to do about it? Imagine, it's October 2025. The price of Bitcoin is $126,000. And then follows the biggest crash in several years. By early February 2026, Bitcoin drops to $60,000, almost minus 50% in 4 months. In the news, such a decline is explained as usual. Investor panic, fear of recession, outflow of ETFs. But not a single mainstream media outlet says that this crash might not have been caused by investors. The cause could have been thousands of trading bots, and no one specifically set them up to repeat the same market behavior. But at the same time, they acted like a cartel, meaning they lowered the price in a coordinated way because they could profit from it. And there's absolutely no one to hold accountable for such manipulation. This incident could have been a movie script, but everything is much more mundane. A study on the behavior of modern AI trading robots was conducted by the Wharton School and the University of Hong Kong. Bloomberg Law describes it with the headline, "Stupid AI bots collude to carry out fraudulent schemes in the market." And most interestingly, according to industry publications and regulators in the world's largest markets, that's the US, Europe and Japan, 60 to 73% of trading volume occurs using automated trading systems. And this is data for the year 2020. And now, with the development of artificial intelligence, the situation could be significantly worse. For crypto exchanges, there are no exact figures in open sources, but according to Kaiko's estimates, a significant part of the liquidity in the Binance and Coinbase order books is from market-making bot orders. Simply put, what a trader sees in the order book is mostly not people, but robots. And they are working against you. A few words about what a cartel is and how it works. A cartel is when several major market players agree not to compete. They fix prices, divide customers and areas of work, and as a result, share the profits. One of the most famous cartels today is the OPEC oil cartel, with its office in Vienna, which decides how much oil will be produced and end up on the market. It should be added that for an economy based on competition, a cartel is not a very beneficial thing. The consumer pays more and the free market ceases to be free. But a cartel requires agreements. These are meetings, calls, and fixed action plans. But AI has managed to bypass this annoying human need. In their study, Wharton ran several trading bots of various types in a real exchange simulation, from primitive Q-learning agents to modern neural networks. And the task was simple. They had to maximize profit. There were no instructions to reach an agreement. Each robot worked autonomously and had no contact with the others. And each robot could only see publicly available market data, prices, volumes, order books. After several thousand iterations, something happened that the researchers didn't expect. The bots stopped competing. Instead of fighting for the best price, they began to simultaneously raise or lower the price by roughly the same volume and in similar time intervals. Wharton even introduced a special metric, the collusion coefficient, where 0 means a perfect competition and 1 is a perfect cartel. For the bots, this metric consistently stayed above 0.5. Their behavior turned out not to be accidental. The robots showed moderately cartel-like behavior. The most interesting part of the study, a cartel is formed not by the smartest but by the most primitive agents without any neural network. Their logic is as straightforward as possible. If a neighbor raised the price and I raised it, we both earned more. Remembered and repeating, smart models can change strategy. Try other approaches to optimize trading. Dumb robots just hold the price and earn together. But that's all in a simulation. But what happens on a real exchange, where what's at stake aren't symbolic tokens but real money? And why does the Wharton investigation call exactly this coordinated robot behavior the cause of the latest Bitcoin crash? So, what do we have at the moment? First, the number of robots of various kinds in real markets is estimated at 60 to 70%. Second, most of these algorithms are adaptive. That is, they don't just execute a set program but learn in real time and adjust their strategy. It was precisely such systems that demonstrated behavior similar to collusion in the Wharton lab. Third, since March 2024, the SEC, that's the US Securities and Exchange Commission, has already filed several dozen cases where AI is mentioned in one way or another. However, among them, there isn't a single case related specifically to manipulation using AI and algorithmic systems. In recent years, not a single legal proceeding has been opened because there is simply no legislative basis for it. In SEC documents, market manipulation using AI is called one of the real threats, but as of today, regulators have no tools to solve this problem. And our main case is the drop in Bitcoin's price over 4 months from $126,000 to $60,000. On February 9, 2026, an investigation by the CoinDesk portal was released analyzing the reasons for this fall. According to CoinDesk, it's all about options market makers. These companies set prices on derivative exchanges and earn not from price movement but from risk protection, that is hedging, and the difference between buy and sell prices, the spread. Here is what happened. Imagine that you are selling insurance against sharp price movements on the exchange. While the market remains calm, you receive a small premium every day, like an insurance company from policyholders. When the price starts to fall, an insurance event occurs, and to limit their losses on payouts, such insurers have to urgently sell the asset itself on the market. And these large sales force the price to fall even further. And a chain reaction starts. Everyone sells, the price falls, insurers sell large volumes, the price falls even lower, everyone sells even more, and so on. This is exactly how catastrophic crashes are born from a normal correction. When the price of Bitcoin started to fall from 126,000, the automatic algorithms of market makers began to sell the underlying asset, that very Bitcoin, in a coordinated way. First a little bit, then more and more. The lower the price fell, the more Bitcoin options market makers were forced to sell to reduce their losses from payouts on insurance against price decreases. That's how Bitcoin fell, and with it the entire crypto market. None of the market makers conspired, chatted in a group, or made special calls. These are several independent companies with different algorithmic trading models. But all these models saw the same market signals, and they are all optimized for the same goal, minimizing loss. And naturally everyone reacted the same way. As a result, the crypto market saw $4 billion in liquidations in a week and record outflows from American Bitcoin ETFs of $3.8 billion. Total losses in crypto market capitalization for January and February amounted to about $1 trillion. This happened not because people were mass scared, but because the algorithms acted like a formal cartel. Just like the bots in the Wharton laboratory. Only instead of virtual money, it's real. Have companies faced any accountability for this? Naturally, no. Formally, no one has broken any rules. And now this is the main headache for all antitrust regulators in the world. Back in 2017, the Organization for Economic Cooperation and Development, which brings together the world's largest economies, published a report, Algorithms and Collusion, where the term collusion without explicit agreement appeared. Since then, regulators have been trying to catch up with the development of technology. The CFTC, the American Derivatives Regulator, in December 2024 issued a separate document with recommendations for employees about the risks of AI in regulated markets. The European Commission in July 2025, through Deputy Director General Lindsay McCallum, confirmed that it is conducting several parallel investigations into algorithmic pricing. However, exactly how to apply existing global antitrust laws to algorithmic collusion is not yet very clear. Okay, while algorithms secretly divide the market and regulators can't do anything about it, the average trader and investor asks, what should I specifically do to avoid becoming fodder for the AI cartel? 3 rules that I formulated after a month of Wharton research, CFTC reports and the CoinDesk investigation. Rule number 1, you are not trading against people, you are trading against machines. When you open a Bitcoin chart and see support levels, resistance levels, double bottoms, head and shoulders, you need to consider that all these patterns have long been accounted for by algorithms. Robots see them, love them, and wait for them. And of course they trade them. For example, when traders buy en masse from support, it's a great opportunity for robots to trigger stop losses. Why? Because statistically, most retail traders buy at these points. Today, classic technical analysis is used not only by people, but also by machines. What do? We look at data on major players, on-chain data, and fundamental information. What are the whales doing? Where are the option strikes set? Where are the flows directed or from ETFs? We look for new analysis tools to beat the machine. Remember that we are working not against the smartest, but against the dumbest robots. And we also study the enemy. We need to know where and how these stupid robots exploit vulnerabilities in our trading systems and bypass them. Rule number 2, a sharp movement is an algorithmic consensus. News headlines like "the market got scared," "panic among investors," "flight to safe haven assets" might be just pretty emotional packaging rather than a real description of what's happening. In reality, tens of thousands of bots could have seen a single signal and reacted to it simultaneously, as happened with Bitcoin in January and February of 2026. The practical advice here is this: don't try to catch the bottom on cascading liquidations in either direction. Averaging down in such moments can be dangerous. The movement might not end until all models have processed the signal to the very end. A trader's task is to wait until the algorithms run out of steam and only then return to the market. Rule number 3, the HODL strategy as an advantage. The most important thing is that AI bots trade in minutes, seconds, and milliseconds. Their strategies are designed for short intervals. If you hold Bitcoin for 5 years, you simply don't fall within the sphere of interest of these algorithms. That's exactly why buy and hold still works for the private investor. Naturally, you need to understand which assets make sense to hold for that long. We live in a world where algorithms have learned to form a cartel. Up to 70% of the trading volume in the markets is done by robots and automated trading systems that optimize profit at the expense of the private investor. And the organizations meant to regulate the markets and protect that very investor openly admit that they can't do anything about it yet. But I'll remind you that we can resist this ourselves. First, hold long-term positions. Second, use tools that robots cannot use and study how trading machines function. And third, keep an eye on your emotions. But markets are only one side of the problem. Artificial intelligence has turned into a tool for scammers. In 2025 alone, $17 billion was stolen from people through crypto scams. I talked about this story in detail in a separate video. Check it out so you don't end up among the victims. Well, if this video was helpful, then like, subscribe and hit the bell. Ciao!